All right. Good morning, everyone, and happy Tuesday. We have our weekly loan desk meeting. For those of you that have been joining us for quite some time, we did end up changing the regularly scheduled timing from 12:30 p.m. Pacific to 11 a.m. And so this week's topic, we are going to be talking about Rocket Mortgage, who's one of our preferred partners at LoanDesk, and their verified pre-approval tool, as well as loan disclosures. So Joe, he is the head of our LoanDesk team, so he's going to be doing a little bit more of a deep dive in both of those topics. So I will turn it over to him. Go ahead, Joe.
Right on. Thanks, Hila. Okay, so as you know, I don't create fancy slides and presentations, but I wanted to go over this because I really think that how we run a pre-approval process can be a differentiator both with conversion of a lead as well as potentially having that offer accepted. It could move the needle on the negotiations. And so I'm going to just go over like my playbook on how I run a pre-approval process and what has worked best for me. And I'm going to get pretty granular with the topic because the devil is in the details. So first thing is we have licensed technology with a company called Sonar. So I take every application through through Sonar. So even if it's like an elderly client who's not comfortable doing things online, I will basically schedule a phone call. I'll go through, I'll bring up Sonar, and I will basically co-pilot, and I'll put all the information for them into Sonar. And the reason why I do this is because A, it's systematic, B, for compliance, so like getting the credit consent, getting the privacy policy acknowledged, all those things just create this one systematic process to take an application. And then you can also then keep track of things, and it just makes your life easier with the loan origination system. So, but most clients, like Sonar, is super easy to use. If you haven't tested it out, I encourage you to do it. One of the reasons why we chose Sonar is because they're very mobile friendly. So it's really actually designed to be done on your phone. So the consumer can just quickly go through and submit their online submission. So why don't we just bring up a loan? And since we don't have any outside. Hey, Joel, if someone from a non-radius joins, just let me know, okay? Because I'm going to share some, data here. I'm going to go into Sonar, and I don't want to, as someone who's not affiliated with the company to see. All right. So let me share this tab instead. All right. So we're going to go, and so you can keep notes here and go through. So you can see, and now this might seem overwhelming for somebody when they look at this, but in fact, actually, it's pretty straightforward. And basically, you have this application tab, and you can see where the borrower is, and it's basically taking a uniform residential loan application and digitizing it. You can have all the client history, property, where they're looking to buy, getting started, their time frame. You can see a multifamily, etc. So in this Sonar, you have a documents tab, and there's a way to like generate a pre-approval directly in this documents tab. And so basically you go in, you price the loan. Now in this case, we have to like update this because it looks like we're the DTI. So he may have completed something wrong. So I have to maybe check with the client. Okay, what's the actual DTI? My point is you can price this out. You can generate the fee worksheets, and this is all mobile responsive for you, where you can and basically generate a pre-approval. And so I'm going to go back to basically this tab. And by the way, if you have any questions, just jump in. I'm just going to really go quickly. So if it looks like a duck and quacks like a duck, it is a duck. So what I mean by that is there are situations where clients need to move quickly. So I'll give you an example. I have a client worked at Google. He's buying a $1 million home, and he's putting 20% down. The money is coming from his bank account. The debt to income ratio is 30%. It's salary income. It's like, it's obvious, So, and he's like, I need to submit an offer today. Okay, so we don't have time to do the verified pre-approval process, but it's very clear that this is a loan. So like while I was on my phone, I could download the pre-approval letter with Sonar, send out that pre-approval via text to both him and the agent. And that is just done on my phone, basically with it, because it looks like a pre-approval. Okay, so that, I would say there's like spectrums of like pre-approval. So the first one, we have pre-qualification, we have loan officer, I would say MLO pre-approval, we have verified pre-approval. So we have one would be a pre-qualification. I have a conversation with somebody. They call me, say, hey, I want to buy a $500,000 home. I'm putting 100K down. I work at ABC company. I've been there 3 years, and we never collected documents. They never did the Sonar link, and you just pre-qualify. Okay, I try to avoid those. I really want to have everything go through the point of sale. The MLO pre-approval is just kind of what I talked about, like looks like a duck, quacks like a duck, is a duck. And you can always coordinate with myself, with Joel or Alicia, and help you if speed is needed. So Jeanette, once your license goes through, you'll have your own Sonar seat, and we do like all kinds of training, and it's super powerful. It's like kind of a steep learning curve, and it looks intimidating, but then once you're in and get it, it's actually quite easy. And then the third one is this verified pre-approval, and this is the most powerful. So the verified pre-approval is where the loan goes into underwriting, is fully underwritten, and it's the same underwriter that will be assigned to the file once the client is already in contract. And so Rocket Mortgage will treat that application like as if the client is already in contract. And so I really push for this verified pre-approval, even for the well-qualified borrowers. So that same Google employee, I say, okay, I'll do the MLO pre-approval. I'll pre-approve you right now, but let's start the verified pre-approval process, because we get like a head start on underwriting. And once then the contract is accepted, then Rocket has a system where you upload the agreement, you answer some questions, and then they send out the disclosures, and boom, you're off and running. So why go for the verified pre-approval, and how do you do it? Now, for most of us, we're kind of newer, and so we have the time, but like I try to create systems for scale. So like I pretend like, okay, let's say if I had 20 applications, right? How do you create systems to handle 20 pre-approvals in a month, 30, 40? And so this is where using the technology is key. So you send out the Sonar link. And then another thing is the client will be prompted to upload documents in Sonar. And so I don't start the pre-approval process until the client has uploaded their documents, because ultimately I want to put the onus to get pre-approved on the client, because that way I'm spending my time on clients who are being proactive and getting pre-approved. So the clients will upload documents. You'll download the MISMO. You'll run credit in Rocket Portal. You'll upload the documents into Rocket, and then you'll submit to underwriting. And then it's currently a 24 to 48 hour turn time to get pre-approved. And then once it is pre-approved, you're going to get in. And Alicia sent basically an example of what it looks like. And let me see if I can pull it up on my end. All right, so you'll go, let me share this tab. So you can see the property address. We just have the city. We don't have the address yet. So It's not in. It's a mortgage first application. So there's no credit. Now the credit was run. Sorry, there's no address. The credit was run through Rocket. This is one of the reasons why we joined Rocket, is because they will cover the cost of the credit report, even if that loan doesn't close. You can see all the documents were uploaded, and then you can see the end result is this verified pre-approval letter. It's very clean looking, and you could even put your own spin on it too if you want to like draft a cover letter with your photo, with your name, with your logo, whatever it might be. But like this is like highlighting this is a verified pre-approval letter. Now here's where I like to go one step further, and I'm sure you guys, I'm talking your language because that's now you're the agents. So after I get that verified pre-approval letter, I will as soon as the client submits an offer, call the listing agent. This is if I can give you one piece of advice, it's this one. And granted, you're all agents here, so I feel like I'm preaching to the choir, but this for anybody who is a loan officer, like this is the one to do, is call the listing agent and then explain, walk through the pre-approval process. So I feel like my job as the loan officer, if I do have a true verified approval, is to make that verified approval letter stand out to the agent, to the listing agent, and say, I just want to go through the process, their pre-approval process. The actual underwriter has already reviewed their income and asset documents. This has been fully underwritten. It's the same underwriter who will look at the file once the contract is accepted. And if sometimes listing agents will get it, they're like, okay, cool, got it, fully underwritten. And other ones may not. They may require more education. Like, what's the difference between this and the MLO approval? Most companies are really focused. Most competitors are really focused on this number two. And the reason why that is, so let's say Better.com is one. SoFi, like they're trying to techify pre-approvals. And there's a lot of money to be made to just picking up the scraps at the pre-approvals that don't close. Because here's what happens when you try to techify a pre-approval. Your output is only as good as your input. And I have learned, having worked with over 5,000 borrowers, that they do not complete the application as correctly as often they should. Let me give you some examples of where this might be. So it would be, so to Brandon, great question. Where's the 506 number? That's what Ricardo, the loan officer, applied for. And if Ricardo wants to do to change that number, they can request a modified verified approval letter. So they can hit request val modification and go through this form. So maybe they want to increase it, or maybe they want to change it. And so this is where I say you can put your own spin on it, because sometimes buyers agents, they want like the pre-approval to like match exactly what their offer is. And so we actually have a LoanDesk pre-approval, and so you can basically go through all the verified pre-approval process, but then brand it how you want. And Joel can share our verified pre-approval for you to look at. So you're welcome to do your own spin. I've done that with verified approvals. Like, rather than submitting the Rocket verified approval, I'll just use the LoanDesk verified approval letter, and then that way it has I can control kind of the content that's on it, but it still doesn't take away that we've gone through the verified approval process. So you're welcome to do that. Joel, maybe after this call with the folks who are on, just share like what our pre-approval looks like, and to each their own. Like, like if you want to just use this verified approval letter, I think that would be fine. But I want to go like, so when you have that, I would say most companies are focused on the loan officer process of doing pre-approvals because they don't want operational staff to be bogged down on applications that may never close because they never get into contract. I don't know what the percentage is, but I would say probably my best guess is like maybe 20% of your pre-approvals will go into contract in the first 3 months. So think about it from Rocket's perspective. Like they're exerting a lot of resources to run this process. Whereas what companies really want to focus on is techifying the process. But I have learned that that leads to mistakes because the inputs are not always correct. You have a tech employee, let's say, and they put their salary as X, but they're actually including the RSU income in their salary. That's a specific example that I've seen gone wrong many times. Fannie Mae has specific guidelines on how you can qualify RSU income. It's quite different than just your salary or W-2 income. You have a self-employed applicant who's been self-employed for maybe 4 years, but they recently went from a sole prop to an LLC. And then now Fannie Mae guidelines has rules on that. You have anything self-employed should definitely be verified pre-approval. But there's all kinds of scenarios, even for well-qualified people, or you think they're well-qualified, where their bonus income is not as straightforward as someone who just receives a salary. So when a client is inputting their income, they're usually not itemizing it in a way that Fannie Mae underwrites the file, and that's why it leads to mistakes and errors. Even if like all the technology is correct, the inputs were incorrect. So after you get that verified approval, you call the listing agent. And here's another reason why I like the verified pre-approval process. It creates stickiness. Because if a client has already gone through this process with you, it's more likely that they're going to stick with you once they get into contract. And now our rates are quite competitive, so I don't really fear competition. But hey, this is a commoditized market, and there's 10,000 mortgage companies. So we're not the only game in town. The more that I can get the client to basically work with me at the upfront process, then in my opinion, then the more committed they are to staying with me after that contract goes through. So, and lastly, this is another thing. So I forgot to mention on the listing agent. When I talk to the listing agent, I will walk them through the pre-approval process. I am sometimes surprised to learn what a listing agent will disclose to the mortgage broker that they may not disclose to the buyer's real estate agent. So any tidbit of information I pass along directly to the buyer's agents. And I always feel like the buyer's agents appreciate that, even if it's like no-brainer stuff. Like they might say, oh, we got 5 offers and we're reviewing them. Well, I don't know if the buyer's agent knows that they got 5 offers. Maybe they told him, maybe they didn't, so I relay that information. Hey, I just talked to the listing agent, let him know, went over the pre-qualifications. They said they got 5 offers. And I'm all about like over communicating on at the beginning. Like I feel like the biggest change that when you are the mortgage loan officer is that you have to do the work up front before the file goes into contract. Once the loan is in contract, especially if the lender that you use is Rocket, it's actually quite easy. Like we've already collected the income asset documents. Rocket will order the title documents. We send the appraisal link so that we can get the appraisal ordered. I have like a standard email template that I send for shopping around for homeowners insurance. That's pretty much it. Like, so all the work I try to do is upfront. And I think this is sometimes like a differentiator between like newer loan officers and more experienced loan officers, is that the experienced loan officers really try to just take care of everything before the contract is signed. whereas newer loan officers, I think sometimes will try to scramble after the contract is signed, and in my opinion, it creates stress. And you potentially, if you did a verified pre-approval process and the buyer's agent's like, okay, this is a, competitive situation, can we do a 20-day close, 21-day close? I would say absolutely if we've done a verified pre-approval. If we didn't go through the verified pre-approval, well, it's still maybe, like, depending on the loan. But if it's a verified pre-approval, absolutely. Now, I always say a caveat, because there's things that dictate the timeline that are out of my control. And that's like, if we get the third party, as long as we can get the third party items in time, then 21 days is not an issue. And I just remind them, like, hey, I can order the appraisal right away, but how long the appraisal takes is not up to me. Now, we're seeing appraisals done really fast just because there's not a whole lot of transactions being done. But I just had a file in Oakland Hills, actually it was just a few months ago, where the insurance took forever. And we actually had to extend the closing deadline. No fault to me. They're like, we basically had this loan, ready to go after 10 days, pending the insurance. And I followed up with the borrower every day. I would give them insurance contacts, contact this person. For whatever, it just took a long, long time for them to get an insurance policy. So I always like to mention, I never like to give guarantees. I never say, oh, I guarantee we can close in 21 days. I always like to say, I can do my part, but there are things out of my control. And so basically that's how I run the pre-approval process. And if there's any questions, let me know.
Sorry, can I belabor the point, Joseph? Going back to the pre-approval letter, it shows a purchase price of $515,000, but he's only qualified for a loan amount of just greater than 1%. First blush, you say, oh, he's only got 1 and change percent to put down. I'm probably looking at that wrong.
So this is an FHA loan, and so he's putting 3.5% down and having the 1.75 mortgage insurance rolled in, and that's how we're getting to the 505. So
3% of 515.
Well, but 3.5% is the minimum down payment on an FHA loan.
Yeah.
Okay, so and then plus you can roll in the 1.75 FHA funding upfront mortgage insurance. So 515. So the base loan amount. So take 515 times 96.5%. So that's 496,975. That's the base loan amount. Under FHA, the way that FHA makes its money is they collect 2 ways. One is a monthly mortgage insurance. The second is a one-time upfront mortgage insurance premium, which is 1.75%. So you take 496,975 times 1.0175, and that's 505,672.
Okay, got it. Thank you.
Yeah. So FHA minimum down payment 3.5%. I've done a few rooms on FHA, and it used to be, hey, try to get every client into conventional. Man, FHA rates are really, really low. Plus, under the Biden administration, they changed the FHA monthly mortgage insurance premium. The annual or the upfront is still 1.75, but the monthly pay is now less. So FHA loans are competitive. We can run the numbers on that same deal. So let's say the client has a 680 credit score, and we're just gonna omit the income right now. We don't really care about the income at this point because we just want to see the rates. Still, Alameda County, purchase, FHA 515. So you can just put in here the LTV. And so Jeanette, once your license goes through, you'll have access to Rocket. And so you can see the base loan amount, 496,975. On this side, you can see finance upfront mortgage insurance premium. So under FHA, you can roll that into the loan, say single family home. Okay, we'll say compensation lender paid. So our compensation to LoanDesk is 1.7 or 1.5. Okay, and say you can label it FHA test scenario if you want to, return to it, or actually with Brian Cruz since that's the so you can go here FHA 30-year fix. So you can see closest rate to no points is 599. 599, and this is with us getting the 1.5%. So like the comp to LoanDesk is 7.585. So like rates have come down. FHA rates are low, and you can see here the mortgage insurance is 226. So their monthly payment is 3255, not including property taxes and homeowners insurance. And FHA is great marketing because if you look at most websites, they're not average. Let's just take Mortgage News Daily. So 7.02% is average 30-year fix. So like when you tell basically that this borrower, hey, you can get 599 and it's pretty close to no points. Or what they can do is maybe even take a 6.25. Now they're getting a $3,300 lender credit to go towards their closing costs. Because sometimes FHA clients, maybe they have the down payment for the 3.5, but they don't have as much for the closing cost. So you can get a credit towards closing costs. So don't forget about FHA. It's because it's become a much more competitive product. The rates are lower, and now the mortgage insurance, which is some ways subsidized by the government. So like PMI is much cheaper if you have excellent credit. But for mortgage insurance on an FHA, it doesn't matter if you have a 620 credit score or 800 credit score. It's the same. So it's kind of like you think about it, the high credit score borrowers are subsidizing it for the low credit score borrowers. So whenever my general rule of thumb is if the client has a credit score below 700, I think FHA is sometimes the better option. If it's above 700, then maybe conventional. General rule. Circumstances could change that. But does that answer your question on how we're getting to those loan amounts?
Perfect. So,
All right.
so loan debt, we're fully approved now through DRE. Is that correct?
Yeah, you are fully approved, Brandon. If you want to write 100 loans today, you can do that.
I only have 27, but okay.
And by the way, right now, don't forget refinances. So if you had a client buy in basically in the second half of last year, basically if you know a client that has a 7% rate, you should be able to help them refinance. So we're doing a refi right now, and now keep in mind with refinances, they're super easy, and so you may even want to, you can always change your compensation if you want to basically enable the numbers to work. But let's just run a quick refinance scenario. I know we're over time, but just I really want to drive this home because we already have 2 refinances in the pipeline. We've been licensed for 2 business days, and we have 2 refinances in. So let's just say it's an A paper client. They bought the home at the peak of the market, and let's say they bought a home and it was, and we're just going to use the same number. So like, let's say they bought a home and it was $600,000 and they owe, let's say, $540 on the loan amount. So, okay, we'll put PMI, client paid. And so this is what I mentioned about the compensation type. Like sometimes for refinances, just because they're so easy, like I might just give the client a better deal just to make the numbers work. So like I'm going to just do that here. I'll just say that, our compensation that we earn, let's just say is 0.5% and a 0 flat fee. So that's $2,700, and I'm going to buy out the underwriting fee so it doesn't reflect on the loan estimate. Let's just say it's a single family home, yada, yada, yada. All right, so test refi. So this person, if they were to buy this home in October, my guess is their rate is right now 7.5. So let's see what if they have a 7.5 rate. Let's see what it would be now. So right now, they could choose a 6.5, so a 1% drop, plus they're getting a $4,000 lender credit. So you're looking at the fees on that loan, total fees of $721 would be the total fee. So think about the savings on that. So you're saving like $400 a month. So you're recouping in 2 months. So this is how easy land refinances are. And the reason why I did a loan that had PMI is because one aspect of mortgages that many people have misconceptions on is that PMI varies widely between mortgage lenders. Rocket, and again, I don't want to like say, toot their own horn too much, but Rocket has the usually the cheapest PMI, and the reason why is because they were one of the largest lenders, so they can negotiate cheaper PMI. So this same person might be able to save both on their rate and on their PMI. Like basically, if they didn't get the loan through Rocket or UWM, they probably have a PMI that can be saved. So these are just easy wins. You send them the Sonar link and they complete it. We upload it. We send out disclosures 30 minutes later. They e-sign. They sign we lock in the rate. We submit the application to underwriting. 24 hours later, loan's approved. Get the title documents from AMROC automatically, and the loan can be cleared to close. If there's no appraisal required, the loan can be cleared to close in 72 to 96 hours. If there's appraisal needed, then the loan will be ready to close pending the appraisal. So I will leave you there because that excites me, because I've done so many refinances that I just know how easy they are.
All right. Thank you so much, Joe. I think that was really valuable for everyone. And I hope that everyone that was on the call today was able to